Well, taking action is what the meeting should do next. But what we are doing next is looking at the commodities segment, especially after the MPC. Last time we had Dr. Adesola Simoni joining us from Reading in the United Kingdom. It was pre-MPC decision, and now it's afterwards. So let's see if this met his forecast. Dr. Adesola, thank you for your time. Good morning. So the 0.25 basis points increase in the interest rate is within what the FDC was expecting.
Indeed. So if you look at the voting within the committee, as well as the sample of economists, there was a diversity of opinions, right? We forecast 50 basis points increase. Some people forecast 25 basis points. Some said they were going to hold. If you look at the voting, for example, out of 11 members of the committee, 6 voted for an increase in benchmark interest rates. Of those 6, 4 chose a 25 basis points increase, and 2 chose a 50 basis points increase. So you can see the diversity, and the other 5 chose to hold. So we were still in line with, we forecasted an increase. Maybe we were a little more aggressive, and the central bank was more conservative. But if you look at the balance of arguments, balancing both, the need to address inflation, which is at, I think, an 18-year high at 22.8%, as well as still allowing room for growth, I think increasing by 25 basis points, I think it was a good option to go with.
So now MPR at 18.75%. What can we expect? How does it affect us?
Interesting question, Amy. So in addition to increasing the benchmark interest rate by 25 basis points, another interesting, important policy was to narrow the interest rate corridor to 100 basis points to minus 300 basis points, which simply, which simply means that other rates in the market would move towards the monetary policy rates of 18.75%. And we've already seen that. If you look at the auction, the National Nigerian Treasury Bills auction held yesterday, you see that the stock rates across different tenures of instruments increased by an average of 462 basis points to 8.72%, compared to 4.1% at the last auction in mid of July. The biggest increase came from the longer tenure instrument, which was the 365-day Treasury bill, which increased by 620 basis points from 5.94 to 12.15%. So essentially, this is kind of we are going to see some more repricing of short-term instruments in the market. We're going to see the rates, the interest rates, or the rates for these short-term bills trend upwards towards the MPR. I think that is positive. It's also kind of narrowing the negative return between inflation rate and the interest rate. I mean, obviously, comparing 12% to 22%, there's still a 10 percentage points gap, but it is better than what it was before. In addition to that, we're also seeing the central bank use different measures to kind of reduce system liquidity. On Tuesday, remember, I told you that we saw a sharp increase in money supply. Money supply increased by, I think, around 14% month on month, and around like 32% year on year. And if you look at the absolute number, it came in around 9 trillion naira more, bringing the total broad money supply to around 65 trillion in June. Also, if you look at the liquidity within the banking system for the month of June, it's averaged around 500 billion naira. So you can see there's so much liquidity in the system, and that was also contributing to inflation. So we are seeing the central bank use other measures, to kind of drain the system of liquidity. For example, we are seeing also the central bank trying to now enforce the loan-to-deposit ratio of around 65%. Which means that for every 100 naira that the banks receive, for example, they can only loan about 65 bucks out of 60 in loans. So that's essentially trying to reduce the system liquidity and also contribute towards reducing the pressure on demand pressure on inflation, as well as on the FX markets.
Yeah, so I guess that increase in money in supply is actually what made a lot of people disappointed, because we saw a reduction in the CRR of merchant banks. A lot of people were expecting that there'll be a reduction in the CRR of deposit money banks too.
I mean, reducing the CRR for merchant banks, though it's expected to have a positive effect on the real economy, meaning that these merchant banks can lend more to the real economy. The effect in terms of increasing money supply, in terms of system liquidity, is muted compared to in reducing the CRR for commercial banks. That will essentially mean that would increase system liquidity quite significantly, and it would be a risk factor for inflation.
So how does all of this affect commodity prices at this time?
The effect on commodity prices is indirect, and at the moment it is muted because it's indirect. It will come in terms of, again, money to the households and businesses, as well as pressure on the FX. So it's increasing, it's kind of tightening. We expect, less demand, less money in circulation, and also less pressure on the FX. If you look at also the FX market, we are seeing some correction, some demand correction because of the high exchange rates. I think as at yesterday, the exchange rates kind of appreciated due to demand correction. Another factor that I did not mention was part of the aim of increasing benchmark interest rates as well as narrowing the corridor is to try to attract foreign portfolio investment into the economy, because at this moment we really need supply for FX. The demand is huge. We also have some what's the word now, unmet demand, pent-up demand that has not been satisfied. So there's a lot of pressure on the demand side. But what we need now is to increase the supply, and that is why the central bank is trying to increase the rates on treasury bills as well as reduce system liquidity, so as to reduce the demand pressure on FX as well as to attract foreign portfolio investments into the economy.
Just before we let you go, the issue of FX demand, does it have seasons? I know there are seasons for school fees, especially for parents who have children schooling abroad. So perhaps the government can target those seasons and bring up the intervention as the CBN at those periods to help cool, the demand.
Indeed, it is seasonal, but that is just in addition, right? We still have manufacturing, for example. A lot of our manufacturing inputs are still imported from abroad, and that means that perpetually we have huge demand for FX, at least coming from the manufacturing sector. Then the demand for instance, holiday school fee season, which is coming next month for schools, many schools in North America, and in September for schools in Europe. So in addition to that, I think also what we need to note is that the central bank is intervening, although at a little rate. Perhaps when there's much more demand on the FX market, we'll see some more intervention by the central bank. But there's perpetual pressure on the demand side at the FX market because of like I mentioned before, demand from manufacturing to import raw materials for production.
All right, thank you so much, Dr. Adesola Sumoni, Senior Analyst with Financial Derivatives Company, for those perspectives shared with us this morning.
Thank you for having me.